Bulls and bears. There's a number on Wall Street this morning that has never been this high, not once in 24 years. Bank of America runs a single dial that measures how much greed is packed inside the market. It runs from 0 to 10. Everybody is terrified at 0. At 10, everybody is all in. The cash is spent and the last buyer has already bought. This week, that dial printed 9.6. This is the highest reading since the bank started publishing it in 2002. Higher than 2004, higher than 2006, higher than March 2018, higher than February 20, which was 3 weeks before the fastest crash in modern market history. And here's a part almost everybody is going to miss. This is not a doom number. It is a timing number. Handled properly, a reading like this one is the most useful gift the market hands you all year because it tells something price alone cannot. It tells you how much room is left. The bull and bear indicator is a blend. Bank of America puts 6 ingredients in it. Where money is flowing, how professional managers are positioned, how much cash they are holding, how many stocks are participating in the rally, and what the bond market is charging risky borrowers, and how much risk the hedge funds are carrying. Blend those and you get one number between 0 and 10. Above 8, extreme bull, and it is treated as a sell signal. Below 2 is extreme bear, and it is treated as a buy signal. And here's the most important sentence in this whole video. The dial does not measure the economy is good. It measures whether everybody already agrees the economy is good and has already bought into it. Those are two completely different questions, and only one of them tells you anything about your future returns. A great economy with everybody already positioned for a great economy is a market with no spare buyers. That is what 9.6 means. It does not mean the news is bad. It means the good news is already inside the price. Before anybody dismisses this as a permanent bear crying wolf, look at what it did in the last 8 months. It did not just talk, it delivered. Back in December of 2025, the dial pushed into sell territory. For nearly 2 months, the market ignored it and ground sideways. Then the floor gave in and the S&P slid to a 1-year low on March 29th. On the exact day, the dial had collapsed to the bottom of its range and the sell signal ended. March 29th turned out to be the precise low of the year. You bought that day, you brought the bottom, then watched it climb back up to the ladder. 8.0, 8.5, 8.8, 9.5, and 9.6 right now. So it's not a broken clock. In one 8-month stretch, it called the top, called the bottom, and is now calling another top. That earns it a earring, right? Let's take a look at the scorecard, right? What are we looking at? Well, there have been 17 of these signals since 2002. On average, global stocks fell roughly 2 to 3% over the following 2 to 3 months. That is it, not 30%. A 2 to 3% average dip. The hit rate is about 60%, which means 4 times out of 10, nothing bad happened at all. But in the worst cases, drawdown reached 15 to 20%. So the average is mild and the tail is nasty. That is this signal in one sentence. Think of it as a yellow traffic light. Yellow does not mean crash. It means you are approaching an intersection. So take your foot off the gas and cover the brake. Most of the time you sell through. Covering the brake is the best decision you made all year. It's correct emotional setting for 9.6, not panic. Preparation. Quick pause. If a plain English breakdown is what professionals are actually doing is of interest to you, hit subscribe and turn on the bell. It costs you nothing, and it is the biggest thing you can do to help this channel keep doing independent work. If you want the full data behind it, the full explanation, and my 10 tools that I provide to my members, then become a member. Simple as that. You will benefit from it. You will not. This is not a house of prediction. This is a house of education. Because the more educated you are, the less likely you are to panic. Let us walk the historical peaks, because this is where the story gets more encouraging than the headline suggests. So in January 2004, the market chopped sideways and gave back roughly 8% through the spring and the summer. Frustrating, but the S&P 500 still finished 2004 higher. In March 2006, a sharp scare in May and June worth about 7%. In 2006, still finished at a strong up year. May 2010, the flash crash summer took about 60% of the highs, and the market still closed 2010 higher. Then the ugly ones. February 2018, and 9 days later, stocks fell 10% in a volatile shock. February 20, and 3 weeks later, the market shut down. And then December 20, extreme reading, and absolutely nothing happened. Stocks climbed for another 12 months and delivered one of the great years on record. This is your reminder that this signal is viable. Count that up. In 4 out of the 6 episodes, the year still ended higher than it started. Extreme greed usually buys you a rough couple of months, not a lost decade. This market is not fragile because the dial is high. It is crowded, and fragiles are cousins, not twins. This is great because essentially, whenever you have market pull down, it's the market being honest with itself. It's saying, you know what, I went too high. Let's do some price discovery. Let's sell. Okay. There's been a couple of, February 2018, 20, October 17. Yes, it went down. And we're probably on the way currently in what's happening currently right now. We ended up the year higher. That is what you need to know. Because at the end of the day, what is really happening? What is so bad right now? What is so bad? Inflation? I don't know. It looks like we have less people fighting for unemployment. But the month before, we had not enough job being created. Okay. Yeah, but as we've seen in the past, if you look at game theory, we tend to start the war. Then we realize, we got to get along to go along. And then we make a deal and then we start again, unless the U.S. decides to invade Iran. I mean, this is like invading Europe. This is not Venezuela. Look at the numbers. Look at the released numbers. It's great. Some disappointment with Tesla. Some disappointment because of how much money AI firms are willing to spend going forward and if it's really worth it. Is that bad? It's a narrative. It's pure narrative. Do not let them keep you away from the stock market. Let's take a look how much cash is held by global fund managers, right? Because this is one of the items included in the bull and bear ratio. So what pushed this to a record? Let's open the hood. Start with cash. The July survey covered 181 investors running $484 billion. Their average cash position is 3.6% of the portfolio, down from 4.1 a month ago. Anything at or below 4 is a warning, and 3.6 is one of the lowest readings in the entire 24-year history of the survey. There have been only 16 prior instances of cash this low since 2002, and here is the untruth of what followed. Global stock fell about 1% over the next 2 weeks and about 0.5% over the next month. That is a rounding error. That is not a catastrophe. But low cash matters for a different reason than most people think. It's about ammunition, not prediction. When professionals hold no cash, nobody's left to buy the next dip. And if clients ask for money back, managers must sell what they already own to raise it. Low cash does not cause a fall. It makes a fall travel further onto once it starts. Where did the money go last week? Now look at last week's flow, and this is part of what genuinely surprised me. Investors pulled $120 billion out of cash and money market account, the largest exit from safety since April. Where did it go? $58 billion into stocks, $20 billion into bonds, $500 million into gold. Underneath that, emerging market stocks took $25 billion. The strongest week since April 2025. Technology funds absorb about $15.6 billion. Financial stocks, $2.7. Read that list back to yourself. This is not the footprint of scared money. Nobody is hiding. Everybody is stepping forward at the same moment into the same trades. And managers are now a net 24% overweight United States equity, the most aggressive positioning since December 2024. The four things almost everyone now believes. Right? Belief number one, no recession, right? 54% of managers expect the economy to keep running. Belief number two, no rate hike. A stunning 83% expect the Federal Reserve to sit on its hands until after the November elections. Belief number three, no cut to artificial intelligence spending. 61% expect the big technology companies to keep spending at full throttle through year end. And belief number four, no political surprise in the midterms. And laid on top of it, a record 73% of managers say owning semiconductor stocks is the single most crowded trade on the planet. They know it is crowded. They are in it anyway. When investors collectively decide that growth will hold, the central bank will stay away, technology spending is untouchable, and politics will not interfere, risk stops feeling like a trade. It starts feeling like an entitlement. That is the mood a 9.6 is describing. And notice the real danger. It's not that the consensus is slightly wrong. It is that all four beliefs are load-bearing. Pull one out and the whole structure has to be repriced at once. Here's the most interesting contradiction in the market right now. The semiconductor index is already down about 20% from its peak. The triple leverage version of that trade is down about 50%. That is a real damage. That is money that is gone. Back in June 3rd, that chip index traded 76% above its 200-day moving average, right? The only time in history that reading was ever exceeded was in March 2000 technology peak. Today, it sits about 33% above the trend. So the tension has come way down. This is healthy. That is a market cooling itself off without breaking anything. I am cooling myself off without breaking anything. That's exactly what you're seeing right now in this indigestion in the market. It's healthy. Have a good burp, and let's go back making money. Is still chasing the trade that already broke. But watch this. Even after the 20% fall, investors put another $2.3 billion into the 8 largest chip funds last week. Year to date, those funds pulled in $46 billion, roughly 31% of everything they manage. And technology funds overall absorbed a record $48 billion in just the last 3 weeks. So say that plainly, prices on one, convictions did not. The screen looks like a washout, but underneath, nobody actually sold. That is exactly why the grid Dow can print an all-time high of 9.6 while the chip complex is down 20%. Pain in price is not the same as pain in positioning, and only one of those marks a bottom. Let's take a look at the macro backdrop, right? The 10-year Treasury yield is close to 4.7%. This is the highest since January of 2025. This is higher than at the time of the tariff situation, if you could remember that far back. And it is up more than 30 basis points in 4 weeks. Why does this matter for stocks? Well, because the 10-year yield is the price of patience. It is a number every valuation model uses to decide what future profits are worth today. When it rises, every long-dated growth story gets marked down automatically, whether the business is doing well or not. And look at what futures market are now pricing. A 33% chance of a rate hike as soon as next week, and a 78% chance by September. That number was 61% just 1 day earlier. Remember belief number 2, 83% of positional and professional managers expect no hike at all. The market is now pricing a 78% chance of one by September. That gap is the single largest fault line in the entire setup. What is driving it is the energy. The Strait of Hormuz is shut again. United States crude inventories are falling to a 45-year low with just 43 days of supply on hand. Brent crudes has pushed above $100 a barrel, right? So roughly 31% above where it sat before the round of the conflict began. So meanwhile, in that same July survey, managers cut their year-end oil forecast to $71 a barrel from $86. The survey was taken during the ceasefire window. The fighting resumed afterward. So the market's oil assumption is already stalled, and it is still in the direction of that hurts, right? Because inflation is in the transmission belt. Monthly price increases have been running near 0.3%, which is, if it continues, puts headline inflation near 3.9 by year end. This is not a crisis number, but it is absurd to keep a central bank in the room when 83% of investors have already shown it the door. Gold, interestingly enough, has pulled back to around $4,000 and now slipping because higher rate expectations make an asset that pays no interest less appealing in the long run. That is a mechanical move, not a verdict on gold. Keep in mind that gold really is mostly interested in the real rate, TIPS, the 10-year, which is around 2.3%. It was 2% last year. It was 2.85% in 2008. So the TIPS, the 10-year real rates, which is basically the 10-year minus inflation, is kind of high right now. Once that number starts coming down, you're going to see gold taking off. Next, I think this is important. Here's a signal almost nobody outside credit desks is watching. It is the one that put you at the top of my list. The extra yield investors demand to lend to high-quality technology companies has widened about 59 basis points since last September to 87 basis points today. In plain terms, it now costs technology companies meaningfully more to borrow than it did 10 months ago. That is happening at the worst possible moment for them. Spending on artificial intelligence infrastructure is expected to hit roughly $800 billion this year, close to $1 trillion next year. Just this week, Alphabet doubled its capital spending guidance to $205 billion, which nobody liked. And free cash flow of these companies, the money left after you build everything, is starting to turn negative. Follow the chain. Spending is exploding, cash generation is shrinking, and the cost of borrowing is rising. The stock market treats enormous capital spending as proof of confidence. The bond market is quietly starting to treat it as a bill that has not been paid. When those two disagree, the bond market usually is the one reading the fine print. You need to pay me. Okay, another part nobody says out loud. This is good news. Reason number one, a 9.1 exists because the underlying market is genuinely strong, right? You're not going to, unless if you don't have a strong market. The S&P has set 23 record highs this year. And the equal weighted version of the index, which strips out the giant, is actually outperforming up more than 12% at the start of July, since about 9% for the headline index. That is broadening participation, which is the opposite of the narrow halo rallies that precedes real bear markets. Reason number two, the excess is already deflating in a gentle possible way. Chips have corrected 20%, while the broad market index is at 3% off its high. That is a market removing froth from one corner without taking the house down. Reason number three, extreme reading mark opportunity zone for far more reliable than they mark endings. Look at the other side of this same dial. It hit rock bottom in January of 2019, in March 20, in May 2020 and 23, and again on March 29 of this year. Every one of those was a superb buying moment. The same tool flashing red today handed you the best entry for 2026 just 4 months ago. If you trust it low, you have to trust it then, right? And that means your job is not to run away. Your job is to get ready. Reason number four, at 9.6 is information you are getting for free before anything has happened. Almost every painful moment in investing comes from being surprised. You are not being surprised. You are being warned in advance with numbers. Well, the market is 3% off its high and volatility is still under 20. That is a most comfortable position from which to make a decision. Okay, so 9.6 is not a prophecy. It is a measurement. It says the market has sailed a long way from shore with an awful lot of passengers leaning over the same side of the boat. It does not tell you the boat will tip. It tells you that if a wave arrives, then it's not much balance left to absorb it. The average outcome is a 2 to 3% wobble, which we are seeing right now. The bad outcome is 15 to 20% correction. I'm not saying it's not going to happen, but 4 times out of 10, nothing at all. Your job is not to guess which one is going to happen. Your job is to be positioned so that all 3 outcomes are perfectly acceptable to you. Because here's the truth. I have learned watching these signals for years. The investors who do well are not the ones who predicted the drop. They're the one who still had cash, still had the list, and still had the nerve when the drop arrived. So get ready now when it is calm. That is the entire lesson of 9.6.